Here is a number that should end an industry. Researchers in Brazil tracked nearly 20,000 people who tried day trading futures. Of those who stuck with it for more than 300 sessions, the committed ones, 97% lost money. About 1% earned more than minimum wage. And yet every year, a fresh wave of traders opens accounts, convinced they are the exception. This is not a story about stupidity. Many of these people are smart. It is a story about hardware. Your brain runs on software written for a world of predators and scarce food. And when you point it at a market, it fails in specific, measurable, repeatable ways. Today, the three bugs that cost investors the most, the academic evidence behind each one, and three defenses that actually work. The stakes here are not abstract. In 2000, Professors Brad Barber and Terrance Odean published a study with a title that gives away the ending: Trading is hazardous to your wealth. They analyzed the accounts of 66,465 households at a large discount broker over 6 years. The average household earned 16.4% a year, while the market returned 17.9%. Not a disaster until you look at the people who traded the most. The most active traders earned 11.4% a year. The market beat them by 6.5 percentage points every single year. Compound that over 2 decades, and the busiest traders end up with roughly half the wealth of someone who did nothing. The activity itself was the cost. So why do we keep doing it? 3 reasons, all in your head. Bug number 1, loss aversion. In experiments run by Daniel Kahneman and Tversky, people consistently refused fair coin flip bets unless the potential win was about twice the potential loss. Their estimate of the pain ratio, losing $100 feels roughly as bad as winning $225 feels good. This asymmetry made perfect sense for your ancestors. In a subsistence world, losing your food supply could kill you, while doubling it just made a nice week. So evolution built a brain that treats losses as emergencies. Kahneman won the Nobel Prize in economics for this work, and it is the foundation stone of behavioral finance. The problem is that markets price risk symmetrically and your brain does not. A system that panics at losses will systematically pay to avoid them, at exactly the wrong moments. Here is what loss aversion looks like in an account statement. Markets fall 20%. The loss is on paper, but your brain registers it as an emergency, twice as loud as the equivalent gain. So you sell, converting a temporary decline into a permanent one. Then the recovery happens without you, because getting back in feels dangerous until prices are high again, which feels safe. Sell low, buy high, powered entirely by a feature that kept your ancestors alive. Loss aversion also makes people hoard cash for decades, terrified of drawdowns, while inflation quietly does what a crash does, just slowly enough that the alarm never triggers. Your threat detection system is calibrated to sudden losses. The slow ones walk right past it. Bug number 2 is about which direction you think the market goes next. Recency bias is your brain's assumption that the recent past is the permanent future. Markets went up last year, so up is normal. Crypto doubled, so doubling is what crypto does. It is why money floods into funds right after their best years and flees right after their worst. Morningstar measures the damage annually in a study called Mind the Gap. Over the past decade, the average fund investor earned about 1 percentage point per year less than the very funds they were invested in, purely from the timing of when they bought and sold. Same fund, same returns available. The investor's entrances and exits, chasing what just went up, dumping what just went down, burned the difference. 1 point a year sounds small. Over 30 years, it is roughly a quarter of your final wealth. Bug number 3 is the strangest one. In 1998, Terrance Odean studied 10,000 brokerage accounts and asked a simple question. When investors sell, do they sell their winners or their losers? Overwhelmingly, winners. People rush to lock in gains that feels like victory and cling to losing positions because selling a loser converts a paper loss into a real one, and loss aversion screams. Economists call it the disposition effect. Odean found that the winners people sold went on to outperform the losers they kept by 3.4 percentage points over the following year. Investors were systematically pruning their gardens and watering their weeds. Tax logic says do the opposite, realize losses, defer gains. The emotional logic wins anyway. Which brings us to the people who make every one of these mistakes at maximum speed. Day trading is these three bugs running in a loop with leverage. The best evidence comes from Taiwan, where Barber, Odean, and colleagues obtained the complete trading records of every participant on the Taiwan Stock Exchange from 1992 to 2006. Every single trade. The aggregate performance of day traders was negative in 14 of those 15 years. In a typical year, about 8 in 10 day traders lost money, and the share who were predictably profitable, good this year because they were genuinely skilled, not lucky, was less than 3% of all day traders on an average day. Brazil's futures market told the same story. Different countries, different decades, different instruments. Same brain, so if the data is this conclusive, why does anyone still do it? Because the market is a slot machine wearing a business suit. Losses arrive mixed with occasional wins, and intermittent reward is the most addictive reinforcement schedule known to psychology. Worse, your brain edits the tape. Wins were skill, losses were bad luck or a rigged market. Barber and Odean found that trading typically ramps up after success. Overconfidence compounds faster than money does. And there is a survivor bias amplifier. The 3% who win are loud, visible selling courses. The 97% quietly close their accounts and say nothing. Your brain samples the visible evidence and concludes the odds look pretty good. They are not. But here is the encouraging part. You cannot patch the hardware, and you do not need to. You can root around it. 3 defenses. Defense 1, make the decision once, then remove yourself from the loop. Automatic contributions on a schedule into broad, diversified holdings mean the buying happens whether you are euphoric or terrified. Nobody panic sells a transfer they forgot was scheduled. This is why workplace retirement plans quietly outperform the same person's self-directed trading account. Not better assets, fewer decisions. Every automated choice is one your loss aversion never gets to vote on. Recency bias cannot chase what it is never consulted about. The behavioral finance literature keeps landing on the same dull conclusion. The interventions that work are the ones that reduce the number of moments a human is asked to act. Boring is not a side effect. Boring is the mechanism. Defense 2. Write your rules before you need them. Professionals call it an investment policy statement, but it can be one page. What do I own and why? What would make me sell? Reasons about the asset, not about how I feel this week. What I do in a crash, nothing, or buy on a schedule. The point is to create a contract between the calm version of you and the panicked version, because those are effectively 2 different people, and the panicked one is a terrible investor. When markets drop 30% and every instinct says emergency, you do not want to be making policy in real time with a brain flooded with cortisol. You want to be reading a memo from someone smarter, you 6 months ago, thinking clearly. Defense 3. Check less. This sounds like avoidance. It is actually math. Loss aversion is triggered by observed losses, and the more often you look, the more losses you see. Markets rise most years, but on any given day the odds are close to a coin flip. Check daily, and you experience loss pain almost half the time, each hit twice as heavy as the gains. Check yearly, and most observations are gains. Same portfolio, radically different emotional diet, radically different behavior. Researchers call the resulting overtrading myopic loss aversion, and it shrinks the moment you widen the frame. Delete the app from your phone's home screen. Turn off price alerts. Every notification is a tiny invitation for your worst instincts to make a decision. Decline the invitation by default. So back to those Brazilian traders. The 97% did not fail because they were lazy or dumb. They brought a survival machine to a probability game, and the machine did exactly what it was built to do. Flinch at losses, extrapolate the recent past, protect the ego. The edge was never faster information or more screen time. It was structure, automation, written rules, and distance. The investors who win are mostly the ones who arranged their lives so their brains rarely get the chance to lose. To be clear, This episode is education, not financial advice. Nothing here is a recommendation to buy or sell anything, so do your own research and talk to a licensed professional before acting. If understanding the machinery behind the money is your kind of thing, subscribe. Next time, we follow the money through the entire AI boom.